will be discussing on Bandhan Business Cycle Fund NFO, which opened on 10th of September, and this will be closing on 24th September 2024. Uh, so we have Vishal, Vice President, Equities Bandhan AMC Limited, to help us to understand this new offering from Bandhan AMC. So over to you, Vishal. Please run us through the latest NFO offering of yours, and how does it fit the investors in their mutual fund portfolio.
Sure, sure. So thank you for the opportunity. Uh, Markets have come to a level where I think it's been a very large tide which has lifted all boats. Incrementally, we need to be very flexible in terms of our investments. We need to ensure that the overall scenario, though good, may not benefit all the sectors, right? There will be enough opportunity for us to shuffle the sectors, to rotate the sectors. And this is where I think a business cycle fund comes in play. And be nimble and have very dynamic in terms of asset rotations. And this can enhance the returns. So this is where we are planning to this is what we're planning to do in the fund. So, and there's other advantages as well. So, and move from one sector to the other, you pay. If I move from one sector to the other fund, right, there are no tax implications. And we will also take some asset allocation responsibilities here. So, as an investor, you are getting meaningful sector cycles today, and it will be sort of a diversified fund. So, there also would be some. So, this is. You can see the presentation, right?
Yes, Vishal, it's visible.
Okay. So, okay. So, is has expansion, slump. Uh, recovering. In this sort of a phase, the demand for loans should be higher. The NPA creation should be lower. Financial lenders should be margin expansion, and profitability also be on an upward trajectory. But in a contractionary phase of the economy, financial should be under pressure as loan growth would slow down. Then there could be increase in NPAs, and also be under pressure. But in a contraction phase, FMCG should do well. The demand for tea, biscuits, toothpaste, soaps, or edible oil, that should be demand should be resilient. So to that extent should be similar. IT should also do well. Most of the IT services are actually essential. So various phases of the economy will have very different impact on the different sectors. If you look at the GDP, it is also
Vishal, sorry to interrupt you in between, but we are losing you from some issue in the network. Yep. So Vishal, your voice was not clear. Probably.
Shall I continue, Saju?
Yeah. So Vishal, your voice was not clear. We were losing you in between. You can go ahead. Just
Okay.
check connectivity.
Okay. Is it okay if I stop the video? Maybe the connectivity might improve a little.
Sure.
Thank you. Am I audible now? Can you hear?
Yes, it's clear now. A bit better.
Okay. 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 So I was saying that the various phases of the economy will have a different impact on the different sectors. I give example of financials and FMCG and IT. Financials will do well in an expansion phase and may not do as well in a contraction phase, whereas the FMCG should do well in a contraction phase, right? And if you see the macroeconomic cycles are also the GDP growth rate is also cyclical. There are some big cycles like the dip that we saw in 08 due to global financial crisis or during COVID. But even if we exclude these two, there are enough smaller cycles that impact the economy. And the impact of this is felt on earnings. If you see the left hand side chart, the earnings growth of the companies, right? Earnings are also cyclical. You wouldn't have seen a company where you are seeing continuous 10% growth rate year after year, right? There are enough cycles. So, and the valuations are also cyclical in terms of the sometimes we are overly bullish, sometimes we are overly bearish, and this leads to an impact on cyclicality of returns. If you see, returns are also cyclical on the right hand side chart. Hence, if we are able to correctly assess the economy and the earnings and valuations and the markets, we should be able to relatively position ourselves in a way where in certain sectors and stocks which should actually meaningfully benefit from that phase of the economy. And if you see the expansion, the examples I gave of financials in an expansion phase, financials should do well. Discretionary consumption should do well, right? Whereas staples and pharma were relatively lag. As if you see in a contraction, because defensive sectors like IT, staples, pharma, utilities, these should do well, and the cyclical sectors should lag. So, if you are able to assess some of these parameters correctly, then there should be a meaningful enhancement of returns. And no particular sector has actually outperformed or underperformed for a long period of time. Right? There is enough sector rotation, and there is a huge dispersion of returns as well. So, if you see any year, right? If you take the case of YTD CY24, the last column, utilities delivered return of 42%. And banks delivered return of 5% only, right? And the overall average return for NSE 500 was just 18%, 19% close to. So there is a huge dispersion of returns. Any year that you see, you will see a huge dispersion of returns. So I think this is where a rotation of the sectors become very important. So which are the sectors that we are meaningfully over invested in, and which are the sectors we are meaningfully not invested in? That should be able to, we should be able to enhance the returns. Now, how do we actually go ahead and select the sectors? If you see the this is an example. If you see the left hand side chart, the blue line is to central government's capex. In 2010, this was close to 2 lakh crores, and in 2021, 4.5 lakh crores. This is just a 6% CAGR. And then in 5 years, between this 4.5 lakh crores becomes 11 lakh crores. So this is a 22% CAGR. Now, if you see the Nifty Infrastructure Index in the right-hand side chart, the performance of the sector has been almost flattish for the period between 10 to 20, similar to the meager 6% CAGR in capex from 10 to 20, right? But as the capex picks up, as the inflection point in 2021 happens, the sector does very well. During this time from 21 onwards, the markets have also done well post-COVID, but infra has been able to outperform. So this is an example as to how we actually go ahead and select the sector. And the next example is real estate. So if you this time let's start from the right hand side chart from the Nifty Real Estate Index from 2008 to 2021, right? Sector was almost flattish. And if you see during this period on the left hand side chart, the sales were almost near or more or the sales of the real estate, sales of apartments was similar or less than the launches. Right. So there used to be a constant inventory buildup, which used to impact the profitability of the lenders. But post-COVID, what has happened is in 2018, RERA was enacted, and post-COVID, as interest rates came down, so the benefit of consolidation of builders and lower interest rates led to a surge in sales. This is reflected in the performance of the Nifty Real Estate Index post-21. So I think this is how we actually go ahead and select sectors. These are some other examples, like auto doing well in an expansion phase of the economy as compared to the broader markets, IT doing well in the contraction phase of the economy as compared to the broader markets. So we have a host of such examples. And now, why should you look at a Bandhan business cycle fund? What we are committing to, we are saying that we will run it like a business cycle fund, true to its name, as to where is the economic cycle, where is the market cycle, where is the sector cycle, uh, which are the parameters that we need to see to determine as to which are the sectors, which are the stocks and subsectors we should be overweight. And if you see, how do we actually go ahead and select the stocks? Once we identify the sector that we want to be overweight on, we first go to the management quality. This is the first filter. Is the management quality strong enough? Does it meet our criteria? Once it does, we will look at the corporate governance in terms of related party transactions, capital allocations, dividend policy, interest of minority shareholders have been kept in line or not. So tax payments, several things. Then we will head to, once we are satisfied with the performance, then we will go to company fundamentals to understand what is the growth rate, how resilient is the performance, what is the competitive dynamic scenario, what how have been the margins, how resilient and steady have been the margins and the return ratios. So a host of such parameters we will assess, and if we are satisfied with some of those, then we will go to valuation. So valuations would be the last, because if there's a stock that is cheap but management quality is not that great, or company fundamentals don't stack up as well, then the stock will underperform in the longer term. Whereas if the management quality is top notch and the company fundamentals are strong, even if the stock is little bit expensive, even then the stock may actually outperform in the long term. So this is the framework that we follow for portfolio creation. And these are some of the indicators that we will follow to assess, which might be positive for certain sectors, it may not be positive for certain sectors. Right? And if you look at the where are the equity markets placed, Indian markets placed as compared to the world. Now, if you see, India has been able to, India has is expensive, yes, and has done very well in terms of the returns. And if we compare this to peers, right, volumes is one aspect, but what has been the earnings growth? Like the earnings growth in this for India is much better, and the ROE of India is also very strong. If you compare this to Hong Kong, which is a market from China, right? We are very expensive, yes, but we have a higher growth rate in earnings and much better return ratios. So this is something that I've already touched. And so this is where, if you look at the fund casing, we are saying that in at least three of the top sectors, we will have a meaningful deviation in weights, where because of which you will get to play the sector cycles. There will be we will shuffle between the sectors depending on where we should be overweight, where we should be underweight. Risk management is important. We will have higher flexibility to keep cash. Most of the funds have a limit to limit upper limit of cash at 10%. We've kept that limit as 15%, because there might be times where we want to be very defensive in the fund. And why should we become defensive only by via stocks, right? You should have some leeway on the cash side as well. So, and here we have not kept any limits on large, mid, and small. As to what percentage of the portfolio would be invested in either large, mid, or small, because this should be a function of which sectors I'm overweight on, which sectors I'm underweight on. For example, if I am very overweight on banks and technology, number of stocks will be less, and weight of large cap will relatively be very large. Whereas if I am, say, someday very overweight on industrials, discretionary, and NBFCs, number of stocks will increase, and weight of small caps relatively will be much more. So the largest weight may still be large cap, but relative weight of small cap will be much more in that scenario. So this is the flexibility that with which we will operate the fund, and should be able to outperform. So if you see, these are some of the examples that have actually played out in the in Bandhan Mutual Fund. As the returns of the auto sector as these excess returns, the returns of auto sector minus the returns of the broader markets, so the excess returns of incremental returns of auto sector, as it started to improve, or weight on auto also improved. And as the sectors, as the returns started to taper off, or weight have started to reduce. So these are some of the examples where we've actually done the sector rotation in our other funds of Bandhan AMC. This is another example. If you can see, as the incremental return of capital goods improved, the weight of the sector also improved, and as the returns declined, or returns were lower, our weights were also lower. So this is something that again we've actually done in the business cycle fund. And understanding risk, monitoring risk is very important. Risk management is actually, risk and return are two parts of the same coin. Management of risk is more important. The return we will make, but it is the risk management which becomes very crucial. Me and my colleague will be managing the fund. I have about 20 years of experience in the capital markets. I'm a chemical engineer and a CFA level 2 candidate, CFA level 3 candidate. And my colleague has got 14 years of experience. This is a fund that people who are looking to enhance the returns of their portfolios should be looking at this fund, but should have a long-term horizon. So key takeaways for us, I will summarize this for you. We will actively monitor the economic cycles, the market cycles, and the sector cycles to pick out where we should be meaningfully overweight, underweight. We will be nimble in the sector allocations. Risk management is an integral part of our investment strategy. And we will, for the stock selection, we will look at management quality as a filter, followed by fundamentals of the company, and lastly, the valuations. So this is where I am. This is what I have to say. In case there are any questions, I would be happy to answer.
Vishal, thank you so much for taking us through this new fund offering.
Sure.
Dear participants, if you have any questions, you can post your questions. Just click on chat and you can post, or you have Q&A. You can click over there and post your questions. So, Vishal, we have the first question. This is more of something related to what the event that happened this week. That is the growth that we see in Nifty in the market. Is it sustainable growth, or is it the right time for people to invest? Because we are at lifetime high, almost making new lifetime high every day. Is it the right time for investors to get in the market, either directly or through mutual fund? I think that's the question I'm sure that you would be getting from a lot of people.
Yes, but a very important one at that. So thank you for asking. I can tell you that I had similar questions or challenges at 15,000 of Nifty, 18,000 of Nifty, 20,000, where people said that aa to gaya hai, but doesn't look sustainable. And again at 22,000, and now again at 25,000, right? We are actually just shy of 26,000 now. People were very skeptical even at 25. So we are saying that, see, this is what we need to keep in mind is, are the earnings keeping pace? Nifty should do an EPS of 1250 rupees the next financial year, 1100 rupees this year. It was 975 the year before, and that is year ending March of 24, FY24, and before that it was about 850 rupees. So earnings have kept pace, right? If earnings are keeping pace, I think markets will continue to outperform, continue to do well. It is when these earnings take a hit that is where we will see some pain in the markets. If you see the risks per se, so the key risk is whether earnings come in or not. Second, or if you look at from the international side, I think most people expect US to have a soft landing, and soft landing scenario coupled with rate cuts should be positive for risk assets, or at least not be negative. We don't foresee a scenario of hard landing in the US, at least till now. Crude has also been subdued because the energy transition has been very strong, has been very fast. Every 100 cars that China sells, 55 cars are EVs, right? PHEV plus BEV combined. So I think energy transition is taking place at a very fast pace. So crude is also okay. Even if there is a spike because of some geopolitics or war and all, it may not sustain there. So I think external scenario is fine. Domestically, we are investing a lot on infra, right? If that is something that takes a hit, we don't foresee that scenario. We think the infra investment will actually double in the next 5 years by the government. So if something of that sort actually plays out, then we should continue to do well. There might be small hiccups here and there in between, like we saw in early August. But other than that, we don't foresee any drastic scenario for the markets. And here in a business cycle fund, I would also be doing enough risk management. Now I can tell you that there are pockets of overvaluation in the markets, right? I run the infra fund. In the infra fund, I had defense at some point in time, which was 13% of the fund was defense, and now it is only 3% of the fund. So there is enough risk management that we also do. We will, if you give me the money today, I will deploy in a way which is most prudent and most optimal. So I think if we have a medium to long term horizon for equities, and ideally that is what should be, because equities is a compounding game. So then we should be able to make enough returns. Is what I think. Are we cautious in the near term? Yes. Are we slightly more defensive? Yes. Do we think the markets are prohibitive? No. There are pockets of overvaluation that we need to manage? Yes. If you take the case of SME, right, we all know there is some level of euphoria at least there. But if you look at Nifty, we don't see that. So I think, and the breadth at which markets have expanded, I think there are enough opportunities even in small. Mid is a category which is constrained to 150 stocks, so maybe some overvaluation there. But as Bandhan Mutual Fund, our fund is doing very well in mid. So I think on balance, I would still say that we remain more positive than negative on the markets. Are we cautious? Yes, but not markets don't seem to be prohibitive as yet.
Okay.
So sorry for a long answer.
That's okay. So the next question that we have is, how is the business cycle fund different from the innovation fund offered by Bandhan AMC?
How is a
How
sorry?
is the uh, Bandhan Innovation Fund different from
Yeah.
Bandhan Business Cycle Fund?
Innovation fund. So innovation fund is very different. See, innovation fund will look to capitalize on certain set of companies, right, which have a very meaningful long-term potential on some new product, on some new technology, or a novel way of doing business. Uh, and some of these may take some time to pan out, right? Some of these businesses are at a nascent stage, or the technology or the product they're working with is at a nascent stage and will evolve gradually. Whereas a business cycle fund will actually capitalize on even on some of the established sector. And I'll give you an example. I foresee a scenario of electricity shortages in India in the coming few years during the peak hours. Peak hours are from 7 to 9 in the morning and 7 to 11 in the evening. So if these electricity shortages actually pan out, then some of the utilities which have merchant power plants may benefit. So now this is electricity is a age old sector, right? Utilities age old sector. Nothing exciting about it, nothing innovative about it. So, as a business cycle fund, I may be overweight on that particular name in future, depending on the opportunity, right? So what I'm trying to say is, even in an established, well-researched, well-established sector that doesn't trade very high, would still offer enough opportunities, enough return opportunities for a business cycle fund. Or for that case, metals, right? Now, I'm not positive on metals today, but at some stage, if I am, right, I can still go ahead and invest in a big way there. Whereas an innovation fund may be very selective. So that is how we are different as compared to innovation.
And so we'll take the last question for the day, which is I
Yeah.
just want to know from you, Vishal, that since it's a business cycle fund, I'm sure there will be long-term bets and short-term bets as well. So do you, as a fund manager, do you keep room to take short-term bets as well, just to generate the alpha return?
See, there will be some tactical ideas that we may do from time to time, but the idea when we select sectors and we select stocks, the idea is to have a medium-term perspective as to which are the sectors that will do very well in the medium term, which are the stocks that will do very well in the medium term. So, because of some market distortions, there could be some tactical plays that could be available to us, and we will try and capitalize on those opportunities as well. But the orientation of the fund, the goal is to generate alpha over the medium term.
Sure, Vishal. I think with this, Vishal, I think we can wrap the call. So, any last thoughts from you before we end it?
Yeah, see, this is sort of an evergreen fund which will have diversification as well, and meaningful exposure to sectors that will do very well. So there should be enough risk management being a diversified fund, and there should be sector returns that we should be able to capture as those some of these sectors will have a meaningful overweight. So hence we think that the returns of this fund should actually be able to be better and should be looked at in any sort of a market, be in a rising market, be it a down market, be in a sideways market. So, yeah. Because the onus of shuffling the sectors lies with me. And since we have a higher cash allocation potential here to at 15%, so if at some point in time I want to be overly defensive, I can do that as well. So this is a fund that should be considered by all.
All right, Vishal, thank you so much for taking the time and taking us
Thank you.
through this new offering, uh, Bandhan Business Cycle Fund NFO. So, dear participants, this fund is open for subscription as on 24th of September
Till
2024.
24th.
Yeah,
Yeah, it will close on 24th. Yeah,
24th, right.
correct.
So, thank you everyone for taking out the time. Have a nice day.
Thank you. Thank you, Saju. Thank you, team, for listening. Thank you.